We are back talking about fixed income market in Nairobi, rather on the Nairobi Securities Exchange. We have Mr. Edwin Chui, who's the head of research at Dyer and Blair Investment Bank. Welcome to the show, Edwin.
Thank you.
Tell us, what are the key themes in the FI market segment for the second half of the year?
Okay, so the key theme, actually, number one theme is the conversation on capping of interest rates, whether they are actually going to be repealed or not. And I think the most important point to highlight is if that conversation proceeds, the demand that we are seeing now is going to change. The bids that we are seeing on bonds in the secondary market are going to disappear, and everything is going to go up. You know, I would expect at least 20 basis points in the medium to long end. And of course, the other key point is that if the change is material enough, commercial banks are most likely going to divert some of their customer deposits towards loans, which of course impacts now the TBO market.
All right.
Yeah.
So you actually expect volumes to be less or more than what we saw in the first half?
In the secondary market?
Yes.
I think they are likely to be less if the cap is completely repealed.
Okay.
But there are other things that are important as themes as well. Number one is delayed payments. We had that discussion just a minute ago. The delayed payments, if you repeal the caps and you do not do something about the delayed payments, you're not going to really impact the lending market.
Okay.
Because I actually really doubt that we have enough quality demand of credit to absorb the kind of money that would come into the market if the caps were repealed. So I think it's important to, one, repeal the caps.
Okay.
Number two, have some kind of a resolution around all these delayed payments from, let's say, county governments, from some retail entities, from the national government as well. And I think the last key point to really reflect on is the excess liquidity in the market. So the bonds market has been quite attractive this year, and mainly it's been a product of excess liquidity. How long can it be sustained? What is bringing that extra liquidity into the market?
I'd like you to answer both questions.
Yeah.
We're very curious. Where's the liquidity coming from?
So I think, in my view, from June, it's actually government payments.
Okay.
So I was curious whether demonetization is having an impact. I think that's probably something you're curious about.
Yes.
I don't think it's actually having an impact as yet. I'm waiting to see with Kenyans, perennial lateness. I'm waiting to see whether it's going to be an issue in September, but so far it hasn't been. It's been pure government payments.
Okay.
I don't think that can be sustained, really. So we do expect, I think we've seen the T-bills kind of start to tick up just a little bit, and I do expect them to tick up just a little bit further in the next 2 or 3 auctions, just as the government keeps up with all these outstanding balances.
Okay.
Yep.
Maybe just my final question on the weekly auctions, especially for the 3-month, the 180, 291 day and 364 day. Last week we saw the market mop up all the liquidity and even some. So rather than taking 20 to 25 billion, which is what it normally takes, it took up 44 billion.
Yep.
Do you expect this to be the trend for the next maybe 3 or 4 weeks?
So they are working with about 154 billion of outstanding. That's bonds and T-bills.
And redemptions for July?
Yeah, and they have a bond auction coming up, which is not very attractive, really, in light of what we've just discussed. If you have potential duration risk coming from potential repeal of interest rate caps, a 15-year paper is not very attractive, especially for fund managers who may have mark-to-market obligations. So what you're likely to see is they may have to take everything they get in the T-bills market to be able to offset that. In terms of where we go from there, the outstanding balances will not be as significant until about September, when you have about 52 billion from bonds alone, that's coupons and maturities. So that will be also interesting. But then the one key thing that we probably should also reflect on is that this remaining half of the year is going to have significant outstanding corporate bond maturities. So you have almost 20 billion coming in from KenGen, from CIC, from NIC, from Consolidated Bank, from UAP, all that coming in between now and October. And it's been yielding about 12.5% to 13%. So in terms of yield preservation, that money is most likely going to go into fixed income because there's nowhere else to generate that kind of return.
So essentially you're projecting a market awash with liquidity. The second half of the year. It's about corporate maturities coming up between October. You have about 154 billion coming up this month. Another 50 billion.
Yep.
What do you think that the equity market can gain for some of the liquidity.
Can
I'm likely to see, because usually and there's a primary auction this week for 15-year.
Yep.
I mean, we're talking some market participants that they're saying that the yield is likely to come just shy of 12%.
Yes.
Almost threatening to go below 12% for a 15-year bond. And as the yields, that means the secondary market yields are going to be even lower, a couple of basis points below 12%.
Yes.
That means that as the yield curve softens downwards, then the hunt for yield is going to move from the fixed end market to equity market. Do you see the equity market benefiting from some of the?
I think the question is what the trigger would be.
Yeah.
Okay.
So there has been no trigger really in the equities market. Actually, if you go back to 2013, equities market has been driven by regulation. You know, we're talking caps, we're talking excise tax, talking VAT. And so the trigger right now may unfortunately be a change in regulation, which is pretty much removal of the caps, right?
Yeah.
That could help the banking stocks. But local fund managers are looking at a situation where you do very well in one quarter, and then in the next 3 quarters you wipe out.
Yeah, that's true.
Yeah. So you'd rather just park in your government securities as long as you're confident that the correction upwards is not going to be immediate.
Yeah.
Yeah.
So tell me two things here. One is around liquidity. One is that we've seen in the first half of the year, primary bond auctions. Performance very strong, in excess of 180%.
Yes.
In terms of bids to offer, but the pickup ratio has been very small. In fact, the central bank has only picked 56% of what has been bid.
Yes.
So we have a liquid market. Central bank is busy withdrawing liquidity from the window via open market operations, obviously being driven by the FX market weakening.
Yeah.
Do you see, in terms of trying to project the performance of this week's primary auction, do you see the central bank picking up everything, or they're likely to be cherry picking again?
So I think they will still cherry pick, but they are cherry picking out of a lot.
Yeah.
Okay. So you have everyone in the market just pretty much going into fixed income.
Yeah.
So yes, they are cherry picking in terms of the rate, but they will still get more than the 40.
Yeah.
More than the 50 actually.
They'll still go for more than.
They'll still go more than for the 50 because they need that money in terms of the obligations they have to meet.
How much do they need, in your view? Do you think the numbers that they've given on the fiscal budget reading are commensurate with what we'll actually see in terms of the CBK coming to collect from the market?
So I think the numbers we've been getting from the budget, especially the initial statement, are not indicative of the numbers that we end up with.
Yeah.
Right?
Okay.
And
They tend to overshoot.
Yes, they tend to
What's the
overshoot.
typical outrun? Is it 10% above? Is it 30% above? Is it 50% above?
So it could actually be more this year so we know the government is looking into paying these outstanding delayed payments, right?
Yeah, so the pending bills.
They are quite significant.
And I think for the last fiscal year, which is 2018-2019, we've crossed with a significant amount of pending bills.
Yes.
Do you have a sense of the extent of these bills?
Yeah, sorry, just...
I've seen numbers going up north of 200.
Wow, that's a lot.
That's a lot.
Okay.
So of course we have a situation where you're going to have maybe some kind of sorting to determine whether the invoices are legitimate or not. But there's a lot of money, even when you speak to, let's say, blue chip entities that are listed. So they do have money owed to them from government entities.
And also from the primary deficit, I think the deficit was about 600 billion from the documents that we saw.
Actually, even more.
But no, that was the formal. I think the formal number was about 600 to 700 billion, and half of that was going to be funded locally.
Yes.
So about 300 billion from the domestic market.
Yes.
But then if you're saying there's also another 200 that also needs to be paid,
yes.
does that mean that we could potentially go to 500 billion?
We could if they mean to actually pay that amount, and I think it would actually be a good thing if the amount is paid, because it's the closest thing to a stimulus that we can get.
That's true.
So I mean, this is a service economy really. So if you don't have policies that are directing liquidity towards the households, then nothing can happen. Even the corporates are not going to do well. They're not going to have quality demand, right? So if you have capping of interest rates, that kind of restricts credit growing to the households. If you have delayed payments to SMEs, that also does the same thing.
And you're also demonetizing in a way. You're collecting the old currency,
exactly,
and wanting to give in new currency.
Yep.
Andrew, you don't sound very excited about the economy.
So I think my view has been that there is a major disconnect between the number, the rate of growth, and the quality of growth. And it's easy to see that in the NPLs. It's easy to see that in the delayed payments we're talking about. also in the number of companies that are either having declines in profitability, and also when you look at some of the entities that are having increase in profitability, they are either relying on, let's say, accounting changes,
especially accounting
innovations, especially in the banking sector, especially in the banking sector.
IFRS 9, this is where our loan loss provision was. This is changing now.
And firing of staff.
And firing of staff. And I think the other day I just heard someone say they are associated with companies whose goods tend to be overconsumed when people are under a lot of stress.
Yes.
So that's like you talk about the beer,
spirits, the cigars,
betting, betting and all this.
Those are the entities that seem to be organically doing extremely well.
And then those entities are now, because of the competitive threats in that sector, they're not necessarily fairly represented on the NSE. Because if it was 5 years ago, EABL would have been able to appropriate the majority of the value from this kind of consumption, but today it doesn't. And neither is the case for BAT as well.
Edwin, just talk about growth, quality of growth, as you obviously saying it's not a very good quality growth, but let's talk about the fiscal stance. I mean, the government obviously is keen. You're talking about fiscal stimulation.
Yes.
Right.
Yes.
Would you make sense of the current fiscal stance, especially the current fiscal year, where the government has made an intention to stimulate the economy fiscally, but at the same time has hiked taxes? I mean, we've talked to people here who called it, for lack of a better word, I think we've called it fiscal confusion.
Yes.
You're stepping on the accelerator.
Yes.
You're stepping on the brake at the same time.
Yes.
Do you share the same view?
No, I think I share. So government spending by itself in infrastructure will definitely grow that output, but it does not really have an impact on tax revenue, because you need the corporates, you need the private sector to be able to sweat that infrastructure. And if you're taxing them, if you're slapping them with regulations, then they will not be able to move into sweat that infrastructure. I guess there's probably hope from some parts of the Big Four agenda, because it could mean money going into households, into SMEs, but it's probably also coming a bit late in terms of its need for funding, because it does require a significant amount of funding. But I think the more interesting question also is, if you have, let's say, foreign entities that are doing a lot of the government infrastructure works, that kind of also delays the return on investment, especially if the money that you're borrowing to do that infrastructure is coming here in kind.
Wow.
Okay.
It's not really being spent here, right?
So you're not buying cement. Zero.
No,
yes.
So this delayed the multiplier effect.
Yes, it delays the multiplier effect. Yes.
And tell me, Edwin.
Yes.
You talk about interest rate caps.
Yes.
What do you see happening realistically? I mean, obviously the CS has proposed in his budget to repeal it. Me and Bida, we have different views. I think it's going to stay the way it is.
I keep thinking there'll be a slight adjustment upwards.
Bida thinks they're going to adjust it.
Okay.
A number of
the ceiling will
or the benchmark guests here
yes.
share in my view.
What do you
think?
So I mean, I think it's all really speculation, because at this point it's a political issue.
Yeah.
And it really goes down to the members of parliament. So I think the only things I can point to that give me some sense of hope is that, number one, we do have less noise around MPs saying we don't want to remove it than we had last year. Number two, you probably have less pressure. That time you had VAT on fuel, which needed to kind of be pushed through. You had caps. So I assume maybe at some point they decided this is a fight for a later date. And then you probably also have some entities now, some institutions coming through, like let's say the Kenya National Chamber of Commerce. I've seen they've taken up the repeal of the cap as a key issue. And I think for the longest period, the repeal of caps has lacked a constituency that is really pushing for it. We are not having that conversation in mainstream media, because if you call the bankers, then the response is like, but these guys just want to make more money, right?
On our behalf.
Yes, on our behalf.
The bankers always making money.
So it seems you think that it could potentially see the light of day, but not in the current form.
Not in the current form. So I am expecting some kind of of a widening
Okay.
of the caps, not really complete removal.
Not a complete repeal.
Which maybe in terms of fixed income market.
Edwin, hold on to that thought. I'll come
Okay.
back and ask you what that means for the fixed income market.
Okay.
But let us take a short break. The market has closed. Look out for the closing bell. We are back dissecting the investment opportunity in the fixed income market. Helping us to have this conversation is Mr. Edwin Churi, who's the head of research at Dyer & Blair Investment Bank. Edwin, before we took the break, we had just suckled in and said there's a potential of an iteration to the rate cap repeal as opposed to a full rate cap repeal. What does that mean for investments in the fixed income market, at least in the second half of the year?
So the pricing that you're seeing in the market right now in terms of demand changes just immediately. Actually, everyone in the market understands that some of these yields we are seeing are not backed by the reality we are seeing out there. So any movement, even a conversation that we will do it tomorrow, will move those bids upwards.
Okay.
So that's, in fact, I think it's probably the best time now to start realizing some of those gains, because I know there has to be a number of investors with significant gains. You know, in the month of June alone, the 10-year has kind of rallied 50 basis points.
Wow.
That's a lot.
That's especially for that market. Okay, but then let's stick to the fact that you think there could be a potential widening of the applicable margins, especially on the ceiling, so it probably goes higher up.
Yep.
Who do you think would be the first person to come to the market? Would it be the banks, who own the majority of the fixed income and have actually been putting more money into government as opposed to lending, or will it be the pension funds?
So I guess the fund managers have mark-to-market obligations that banks are able to work around by initially deciding whether it's held to maturity or available for sale.
Okay.
So I would imagine, especially in the secondary market, banks won't be very quick to come into the secondary market. Fund managers will probably be the slowest to come into the secondary market, and they probably may have to look into banking stocks. In fact, the trade is you sell fixed income, you buy banks.
Yeah.
And
that's a profitable moment. Trade fixed income.
Yes.
Buy banks.
And buy banks.
Depending on.
Depending.
There are a couple of moving factors there, because what you're saying is if nothing changes, then he sees more opportunity in the fixed income market. You're better off doing 12% for whatever tenor of paper that you get as opposed to equities.
So that's an interesting point. I think number one, inflation is ticking up. 5.6, 5.7 now.
Yeah, but still below the MPC's
still below the MPC's upper band. So that means the 91-day yield is really going towards negative now in real terms. And then I guess the conversation on MPC is, I think for the longest time I've believed that the only reason MPC is not moving is because you have the caps in place.
Exactly.
So if you remove the caps in place, you most likely will have MPC cutting the rate, and that may probably mitigate some of the upward pressure on yields that we expect to see. I think the other interesting point there is the currency, because although we're kind of celebrating low yields on the one hand, we kind of have to recognize that it's making USD long positions pretty cheap.
That's
because
true.
You're actually very right, because now I was just talking about the treasurers, and it's so easy to go long now because you're funding them at 2%.
Yes.
Last week, the interbank closed about just 2.3%.
Yes.
It's so cheap to fund long position in the Kenya shilling.
Yes.
And which is why the central bank actually is actively monitoring. And today, we just got off the phone with one of the treasurers. The central bank is seeking to mop up 40 billion shillings.
40 billion.
Yeah.
That's a
just
lot.
today alone.
Just to manage liquidity and
7-day and 14-day term auction deposit instruments. And the pricing is just about 5%. So it's easy to fund long positions now.
Yes.
But Edwin, my question is, do you think that if, I'm just going back to the cap discussion, obviously I don't think something's going to happen with the caps.
Okay.
But you think that there's going to be a slight widening of the cap? What quantum of widening will trigger lending? Because say if they did 200 basis points, is that enough to trigger lending in the economy? Given the fact that credit risks are already very elevated in the market, talk about NPL ratio of about 12% going up. what quantum would actually trigger active lending?
So it's a good question. I don't think there is an actual quantum that is isolated from the government also doing something about the delayed payments.
Yes.
I think until you should definitely widen or remove the caps, but if you actually want to trigger lending, you should also definitely make sure that all those outstanding payments are kind of addressed one way or another. Because you're talking about if you look at what has happened in any other market with interest rate caps in place, NPLs always shoot. So you could actually argue that some of the 12, 13, 14% we are seeing is probably not the real picture. The real picture is probably 16, maybe even higher.
16, 18,
maybe even higher for the.
You talk about 15-year likely to come at 12%.
Yep.
Yeah, that's very minimal. And
so I guess we've seen a potential. I think it was an extra 6% widening. I guess that would definitely be helpful in terms of consumer lending, which is important. We discussed about Kenya being a service economy, and consumer lending really feeds into household kind of spending. So that's important. It will definitely create some kind of activity that can help some of the corporates that are in the FMCG sector.
Sorry, Judge.
So I was just going to ask you that, Edwin, monetary policy is sitting next week. Have you modeled any scenario? What's your view? Do you think they're likely to change the stance?
I don't think they will change the stance until the conversation on the caps is done.
Yes. What does that mean for fixed income market? It's still a gravy train.
It's a gravy train, but you gotta be sophisticated. Because you see now, with everyone moving into fixed income, it means whenever we have correction, there will be a lot of volatility. And you have to assume that maybe a lot of market players are probably not prepared to deal with that volatility, just because they have different reporting obligations, they have different liquidity needs, etc., etc.
I was going to ask just on the same question. When you're looking at the fixed income market, where is the bulk of the demand? Is it foreign demand? Is it local demand?
It's local demand. Local demand.
So foreign is not doing a lot.
Foreign is not doing as well because you do have other markets where the yields are much better, and they also have
Which
currency.
I know we were discussing Egypt last week.
You probably have Egypt. I would bet even now Nigeria is doing better. In East Africa, I think Uganda is doing better. And I think the conversation of you guys are managing your currency, your currency is 17.5% of value, that kind of created a fear factor.
Actually, what do you think would trigger that downward correction
of
17.5%, which has been put out there
of the shilling? So now you're talking about 6.2 months of import cover, which is quite a lot. And I guess they are able to support. They've done $130 million down in June. And I guess it makes sense to them because you probably got this money at 100 to the dollar, and now you're getting out at 102, 103. So you're in the money. But on the flip side, your foreign debt refinancing obligations are increasing by the same quantum. So to what extent is our foreign reserves hot money? I think that's a question.
That's a very interesting question.
Diaspora remittances, you don't think this enhances
we're now doing
the
almost $3 billion in remittances.
We are doing almost $3 billion. I think it's always been an interesting question because when does it stop? Is it driven by maybe negative circumstances?
That feels like we need another whole session for that conversation, but our time is almost up. Tell us, Edwin, as you leave, so what are you telling clients to do, because you're head of research? What are you telling them in terms of fixed income, in terms of equities, holding everything constant?
So in terms of equities, I think there are definitely some key banking stocks that have value no matter what happens to the caps. KCB has value. I think Cooperative Bank has value. I would still say Equity Bank has value. There's a dividend play still in Standard Chartered and Barclays Bank. EABL has value. We expect to see their results next week.
Next week on Friday.
Next week on Friday. We're going for the briefing.
Yes.
We'll ask you about that when you come back.
Yes. I would suspect BAT has value. I feel like their immediate competitor has not had a very good year. So I think they have value. But in terms of the fixed income space, I think you have to play 7 to 10. 7 to 10 range there. There's potential
in terms of the tenure.
In terms
of
7 to 10 years.
Yes.
That's the best. Especially you talk about Medium term, short term?
Medium
Okay,
term. So
medium
the
term.
short term is complicated because T-bills don't stay at 6.6% for long.
Okay.
If you
Yeah.
look historically, T-bill 91 going below 7.5% always corrects back.
Okay.
Okay.
Interesting.
Yep.
All right. Thank you so much for coming on the show. There you have it, ladies and gentlemen. If you're going to the fixed income market, playing the 7 to 10 year tenor, expect more volatility on the short end of the curve. And when you're looking at equities, there is some value to be picked up, especially on the banks. And the newcomers that we're hearing today, EABL and BAT. Look out for this and more. We'll leave you with the market highlights, and we look forward to seeing you later on. Good evening.